Welcome to Providence Property Group's housing market update for April 2019. This month we're reviewing housing market trends through to the end of March. Residential real estate underpins Australia's wealth. There is $6.3 trillion of residential real estate in Australia. This represents 52% of household wealth, and it is 2.5 times the value of super balances. Now, the reason this is important is that residential real estate will continue to be supported by the government and by the Reserve Bank during times of economic turbulence, because it is such an important part of the nation's overall wealth. At a national level, if we look at the performance of the combined capitals, we're seeing that the quarterly rate of decline has eased off, and we're seeing similar declines to those that we saw in the 2008 downturn. National dwelling values fell for the 17th consecutive month in March 2019. However, the 0.6% monthly fall was the smallest since October 2018. This is important as we're seeing the magnitude of the falls getting smaller and losing momentum. Over the past year, national dwelling values have fallen by 6.9%, which is their largest annual fall since the GFC in February 2009. Combined capital city dwelling values were 8.2% lower, and combined regional market values were 2.1% lower. The positive news is that although not all capital cities are recording value declines, the rate of change is slowing across the board. Not surprisingly, premium dwelling values continue to record much larger falls than those of more affordable housing, and we've been able to help many clients buying a home in the premium end get significant discounts over the last 12 months in particular. We've also been buying at very good discounts for our investment clients in the $400,000 to $900,000 range. Obviously not the same magnitude dollar value discount that we've been getting in the premium range, but certainly some very, very good discounts and very, very good buying for our investment clients. In Sydney, values have fallen 3.2% over the last 3 months. Values are 10.9% lower over the past year, and values are now almost 14% lower than their July 2017 peak. In Melbourne, values have fallen by 3.4% over the last 3 months. Values are 9.8% lower over the past year, and values have fallen by 10.3% since they peaked in November 2017. Brisbane home values fell 0.7% over 3 months to February 2019. Values are 0.5% lower over the past year, and values are now 1% lower than their April 2018 peak. Adelaide, values fell by 0.5% over the last 3 months. Values are 0.8% higher over the past year, and house values were 0.7% higher over the past year, while unit values were 1.2% higher in Adelaide. In Perth, values fell 2.9% over the last 3 months, and values are 7.7% lower over the past year. Values are now 18.1% lower than their peak in June 2014. We've been able to pick up some terrific value in Perth for clients. We recently picked up some units for clients at $255,000 in a very good suburb. You did hear that correctly. We were buying for clients units at $255,000. Great value. Certainly something that sounds pretty shocking for those Sydney and Melbourne investors who would never think you'd be able to pick up a great piece of real estate for that kind of price, which you certainly can if you know where to look, which we certainly do. In Hobart, values rose 1.2% over the 3 months to March 2019. Values are up 6% over the last year, and over the past 12 months, houses have increased in Hobart by 5.7%, and units are up 6.9%. Now, what you need to be mindful of in Hobart is that Hobart has had very little property price growth over the 10 years preceding its recent growth spurt, so really it's time for it to make up for that lost ground. In Darwin, dwelling values fell 3.9% over the last 3 months. Values are 6.8% lower over the past year, and values are currently 27.5% lower than their historic peak. In Canberra, values are unchanged over the last 3 months to March 2019. Values are 3.1% higher over the past year, and house values have increased 3.9% over the year, while unit values rose 0.2%. Property sales activity is well below the decade average due to significant falls in settled transactions across Sydney and Melbourne. So we've seen sales volumes drop off dramatically. This is another factor which has created opportunity for us and for our clients to drive harder bargains and buy at prices much lower than we would have been able to get in 2016 and 2017. You can see from the chart that days on market, which is the time it takes to sell a property, has increased significantly over the previous months. This reflects the overall weakness in the market. Importantly, as the housing market weakens, we're seeing vendors having to offer larger discounts in order to secure a sale. This has been great for our clients, and we've been able to buy them properties at prices they never would have been able to buy for a year or two ago. We've seen auction markets picking up over the last few months, showing that vendors are becoming more realistic in their selling expectations. Housing credit is expanding at an historically slow pace due to much tighter credit conditions, and the slowdown in credit growth largely due to a sharp reduction in investment lending. Investment lending is down 29% over the past year and 50% lower relative to the 2015 peak, and more recently owner-occupier lending has dived sharply. It's down 17% over the past 12 months. And once again, this is indicative of a great time to buy. Buy when there's less heat, there's less sting in the market, and you're able to negotiate a far better deal. So if you're out there buying for yourself, or if you do need help, it's certainly a great time to buy, a great time to negotiate, and a great time to put the squeeze on sellers. It's very much a buyer's market at this time. You can see here that in each of the charts representing each of the states that investor lending has been falling in every state. So what about the future of property? Well, if you've worked with Providence before, and if you know a little bit about our research, you'll know that the future of property is a lot more certain than many people understand. And that's because most investors do not study history. We are very keen students of history. History does repeat over and over, but you need to study the cycles. This here is our description of the real estate cycle. It's very predictive of what will happen next, and will give you a very quick snapshot of where we are in this cycle. So we're currently at the end of this second phase of the cycle that we call the first upswing and return to growth. This is the second phase in the cycle. And we're at stage 12 in this phase. Stage 12, which we envisage will run across the balance of 2019 and into 2020. We've been expecting this for many years, and we're seeing this stage that we call a mid-cycle slowdown. It typically lasts about 12 to 18 months. And interestingly, in the last cycle, this timed with the dot-com crash and the World Trade Center attacks around 2000 and 2001. Now, there can be a lot of pessimism. This stage in the cycle brings out all the perma bears, saying that we expect to move more deeply into financial crisis. We're not expecting this mid-cycle slowdown to be serious nor long-lasting. It's not going to involve precipitous drops in land value, so it won't squeeze the banks, and we expect to move out of this phase later next year and into another boom phase. Now, if you want to understand better what to expect from the cycle, where we are, what will come next, please visit our events webpage and sign up to attend one of our next events at the end of May, where we go through this in far, far more detail. This will give you some great insight into the property cycle, where we are and what to expect. Thank you all for watching, and we look forward to working with you.